Let's jump right into this expert-level explainer. Today, we're tearing down the institutional commercial real estate acquisition lifecycle and the intense financial underwriting you need to vet multi-million-dollar deals. We're skipping the basics. We're moving straight from raw data processing into hardcore critical analytical thinking. Here is our roadmap for today's masterclass: market intel and deal lifecycle, the underwriting architecture, calculating net operating income, sizing commercial real estate debt, and finally, due diligence and closing.
All right, starting off with part 1, market intel and deal lifecycle.
So, looking at 2026 acquisitions, the overarching theme is a massive pivot towards scarcity and necessity. It is all about essential services now. Take digital infrastructure, specifically data centers. This sector is just being pulled forward by massive cloud and AI workloads, which is creating incredibly tight vacancy rates. And then you have MedTail. This is a brilliant concept that integrates healthcare facilities right into high-foot traffic retail spaces. You might be asking, why does this matter to us? Well, because aligning with demographic shifts, like an aging population and outpatient migration, creates those long-term, stable leases. And honestly, those are the ultimate value drivers for any portfolio. Okay, so once we identify a target asset in one of those high-growth sectors, it drops right into this strict 5-step transaction lifecycle. Think of this process as a highly critical deal funnel that enforces a strict kill discipline. It acts as a ruthless filter. We want to rapidly kill marginal deals early on, so we're only passing high-conviction targets into the underwriting phase. Actually, you might find yourself filtering through dozens, maybe hundreds of opportunities, just to find a handful that actually qualify to move forward. Moving right along to part 2, the underwriting architecture. What's truly fascinating here is how we transition from raw, messy property data into a highly structured mathematical model. The core of this analysis relies on a 7-step underwriting framework. Analysts systematically structure everything, right? Starting from the physical property info, extracting data from a messy raw rent roll, and plotting out existing lease expirations. From there, they map out the operating pro forma to eventually calculate target internal rates of return, or IRR, and equity multiples. This entire process transforms a static snapshot of a property into a living, breathing financial projection. Now, the crucial point here is modeling what happens when a current lease expires. We do this using market leasing assumptions, or MLA. You can't just assume a tenant stays forever. You've got to assign a renewal probability, say a 75% likelihood of retention. This creates a weighted average in your model based on 2 scenarios: a renewal where the tenant stays versus a new market lease where they completely vacate. And notice how costly variables shift based on those probabilities. Tenant improvements, or TI, and leasing commissions are significantly higher if you have to attract a brand new tenant to backfill a space compared to just retaining your existing one. Plus, we lock in expense reimbursements through mechanisms like base year stops to model our future cash flows accurately. With our leasing assumptions locked in, we reach part 3, calculating net operating income. As you well know, net operating income, or NOI, is the industry standard metric for a very good reason. It strictly isolates a property's core operating profits prior to deducting financing costs, depreciation, income taxes, or capital expenditures. It gives you a perfect apples-to-apples baseline before you muddy the waters with a specific buyer's capital structure or tax profile. Let's map out this mathematical flow in practice. We take an effective gross income of $638,875, and we subtract our operating expenses to derive our pure NOI of $415,000. But the analysis absolutely does not stop there. To find our unlevered cash flow, we then have to deduct those crucial leasing costs we just talked about, in this case, a $12,000 tenant improvement allowance and $3,000 in leasing commissions. That brings our true unlevered net cash flow down to $400,000. With our cash flow clearly mapped out, let's jump to part 4, sizing commercial real estate debt. Institutional lenders size their debt utilizing 3 primary risk mitigation thresholds: loan-to-value, debt yield, and debt service coverage ratio. Now, the standout metric here is absolutely the debt yield. That's your NOI divided by the total loan amount. Because it's completely independent of fluctuating interest rates and amortization schedules, lenders view debt yield as the absolute purest measure of absolute debt capacity and downside risk. Then we have the debt service coverage ratio, or DSCR, which is a vital piece of the puzzle. It simply divides our NOI by the total debt service payment. It ensures there's a comfortable surplus of net income left over after the mortgage is paid. Now, over the last few years, due to higher interest rates and compressed operating margins, commercial lenders have really tightened the safety requirement. They're pushing minimum DSCR requirements up to around 1.35x. Look at how this mathematical back-solving works in practice.
We take our underwritten net cash flow of $400,000 that we calculated just a minute ago. If the lender requires a minimum 1.25x DSCR, we simply divide our $400,000 cash flow by that 1.25 ratio. This immediately caps our maximum allowable annual debt service payment at exactly $320,000. From there, using prevailing interest rates and amortization terms, the lender easily determines the maximum total loan amount they're willing to extend. All of this math provides a fantastic model. But let's be real. Underwriting is just a set of unverified assumptions until we hit part 5, due diligence and closing.
The due diligence phase is the ultimate verification pillar. This is where your team rigorously audits the seller's claims. You have to obtain historical P&Ls, operating statements, bank records, and literally audit selected invoices. You perform intense market analysis to validate those rent assumptions we made earlier, and you absolutely verify the actual physical and environmental condition of the building. The entire goal here is to ensure the mathematical model we built aligns perfectly with the physical and financial reality of the asset. Once everything is validated and the buyer is fully satisfied, the transaction reaches the closing stage. This is where title companies, escrow agents, and real estate attorneys finalize the heavy legal execution. Funds are wired, ownership is officially and legally transferred, and the true work of executing the business plan through asset management can finally begin. So after navigating that macro deal funnel, meticulously structuring the lease math, and sizing the debt strictly by DSCR and debt yield metrics, the ultimate test remains. When you put all of this verified, stress-tested data into your final memo, does this deal actually pass your investment committee? Or did your kill discipline fail you? Thanks for joining this explainer. Now take this framework and go ruthlessly evaluate your next acquisition.